So this webinar is a webinar where we will be hosting Sarit Harper, and it's actually something we have been waiting for 4 months, or actually even longer, because we've been planning this for so long, and now we're finally here where we can present Sarit and let him tell you about the system he has developed to trade forex, and especially the indicator that he has developed that some of you have received and tested out. And even if you haven't received it, you can still follow this webinar. And I think you can probably see my screen now that in the background here I have a landing page, and now I'm just showing the Danish landing page. If you go to Daytrader.dk, and you can also go to the Swedish page or the Norwegian page, and if you press this one, which is about learning to trade the forex market, you will come to this landing page, and this is the landing page that describes this training program that we are part of. And if some of you for some reason shouldn't have been onboarded in this and want to know more about the training program and get the free lessons that are part of the program, then go as fast as possible to this page and sign up, because you can actually get a free version of the or trial version of the indicator, which is showing supply and demand in the forex market. And this is an indicator that we've already been talking about in some webinars here, but we're going to talk about it again tonight, because we have the man who has developed this tonight with us, and that is Sarit Harper. And his system is a system he has developed, I think, over the last 10 years or so, but Sarit can tell more about that. It's called Pipnotic, and it includes, amongst many other things, this indicator which shows supply and demand in the forex market. And this webinar is, as you can see, it's going to be in English, but Sarit is actually fluent in Danish, and we met him in Copenhagen several years ago, and for this reason I think maybe Sarit is going to give us a small greeting in Danish, because we're all Scandinavians. It's a Scandinavian audience here tonight, but first of all, I would actually like to give the screen to Sarit and say welcome for being here. And Sarit, I don't know if you could start off by telling us where you are in the world.
Yeah, sure. Hi, everybody. Thanks so much for having me, Christian. It's an absolute pleasure to be here. Currently I'm in Mallorca, in a house in kind of central Mallorca called Santa Maria del Camí, as they call it. And it's nice. It's beautiful. It's been a beautiful day here. The sun's been shining. We just had some dinner, and now we're get down and talk about trading, which is my favorite topic.
Yeah, and one of the reasons why we think it's interesting to have you with us, Sarit, is you're actually living the dream. I think that many traders like to think about. Like, you've been traveling the world. You've been living in Bali after you left Copenhagen. You went to live in Bali for some years, and you are spending time with your family and doing what you love doing, and you're just putting your own day together by trading and developing your algorithms and indicators. So I think now you told me you're actually going back to Bali, right?
Yeah, the reason we left Bali was because the school was closed, and the school stayed closed for a whole year. And so we thought, we need our kids in school. And so we came back to Europe, a slightly warmer place than Copenhagen. And we thought, well, we'll try Mallorca and kind of wait it out and see what happens. We're hoping to stay a little bit longer, but we just miss Bali, and we haven't really fallen in love with Mallorca, despite the fact that it's a really beautiful place. We just want to get back to Bali. We like the ambience and the tropics, and it's a very beautiful place to live.
So how was your usual day in Bali? Like, how was your working day?
Well, we lived really close to the school where our boys went. The school was situated in the middle of a jungle in central Bali, and we used to just walk down like a path through the jungle to school, just drop off the kids. It was maybe a 10-minute walk, and then come home and then get to the charts. And it was beautiful. It was a very inspiring place to live and to work, because here in this house, there's walls here, they're a meter thick. and so it's quite claustrophobic. And in Bali there are no walls, and so you're always outside. You're sitting on the toilet, and there's a banana tree kind of hanging in, and it's lovely. It's a really nice way to live. And so I'd sit upstairs at my wife's desk if she wasn't occupying it, and I would just sit and do my programming and look at the chart, and it's beautiful, and constantly listening to the sound of the birds singing and the chickens, and it's beautiful. It's a very, very beautiful place to live.
Sounds nice.
Yeah,
Great.
stunning.
Okay, but let's get to it. The charts and your forex, your indicators, your system. Let's hear what you've developed over the last. Is it 10 years, or how long time is it?
Yeah, so I mean, it's existed. Really quickly, just to tell everyone how I got into trading. For the past 23-4 years, I worked in the field of IT security, and I really into computer hacking. And I thought, well, I better try and use these skills in a way where I'm not going to get thrown in jail like some of my friends did. And so I found a job where we would get paid to identify security vulnerabilities, vulnerabilities in software for various different companies. And most of the companies that we worked for, they were pharmaceutical companies, tech companies, and there were a lot of banks. And so I spent a lot of my time sitting in banks, testing trading software and liquidity distribution engines and fixed protocol interfaces and stuff like that. So a lot of really cool, exciting pieces of these big banks' infrastructures. And so I was introduced to this stuff quite a long time ago via my security work, and I got to know a lot of these institutional traders. And over the course of about 10 or 12 years, you slowly get to build up some friendships with these people, obviously, that you're working with. And so I used to ask a lot of questions about what they were doing, and I didn't really understand the concept of buying euros with dollars. I didn't really get that. And so they were sweet, and they'd spend a lot of time explaining things to me, and I thought, wow, this is very interesting. And there were some things that kept coming up. When I would ask the economists, or I'd ask the prop traders or the currency traders what they were doing, they would always talk about liquidity, and they would talk about orders, pending orders, limit orders, stop orders, all sorts of stuff. And I didn't really know what this meant. And so I kept asking questions, and I did a lot of reading about market microstructure, which is a fascinating topic if you're into that. If you're not, it puts you to sleep quite quickly. But it was a really interesting opportunity to kind of to pivot into that world. And so in 2010, I started developing this software, which was based on a lot of the things that the economists and the traders were telling me. And they were talking about liquidity. I didn't get that either, but eventually I got it, and I understood that it meant orders, so willing buyers and sellers in the marketplace. And then there was a lot of talk on the economists, and this was always directed about the strength of an economy, which I initially didn't understand. And they were talking about, like the Big Mac and a lot of the key figures that come out of every country relative to the health of the economy. And so I converted this in my much simpler mind than these economists into strength, relative strength. So you have one economy, you have the European Union, the Eurozone, and you have the American dollar, and these economies are competing. When you take the currency and you put it together as one, if the euro is strong and the American dollar is weak, well, then the euro American dollar is going to go higher. And if it's weaker, then it's going to go lower. If they're equal, then it's going to be ranging. And so I thought, well, that's really interesting. And having a software engineering background, I tried to convert this into a piece of software, which I did. And this was currency strength software, which I've developed extensively over the course of many years. And so my supply and demand software focuses on the stuff that the traders are talking about, and my asset strength and currency strength software focuses on the stuff that the economists kept sharing with me. So this is essentially how I did it. And about 3 years ago, I decided to retire from the hacking industry and then focus full time on my software and trading business, which is what I do now full time. Yeah, so I mean, today we're going to talk about a really, really exciting topic. It's something, I mean, it's so exciting actually but so badly understood by mainstream in the investment space that I'm really pleased to have this opportunity to share a lot of these thoughts that I have about currency trading. And when I speak to my bank, I use Jyske Bank in Denmark. All of you will probably know Jyske Bank. And I asked them, hey, can I trade like my pension? Can I move that into an FX account and trade Forex? And they'd say, no, you're crazy. You can't trade currency markets. Oh, it's so risky. It's terrible. And so even my bank advisor, rådgiver, was misunderstanding, I feel at least, currencies and how you can actually interact with the currency markets very, very safely without losing your shirt. And you can interact with it and you can invest and you can buy one currency with another and you can get out of that position. And so I'm quite excited actually to talk about this topic, because it is something that keeps me awake at night sometimes when I think about it. So what we're going to talk about today is we're going to talk about something called liquidity exploration. And liquidity exploration is essentially when you have a marketplace, rather you have willing buyers and sellers in a marketplace. So you have supply and demand, and then trying to find out where supply meets demand at an area where both buyers and sellers are happy. This is really interesting, and this is a huge opportunity if you can spot these price points or these windows of prices on a price chart. So we're going to talk a little bit about this this evening. So the agenda is we're going to talk about liquidity. I mean, what is liquidity? This is something I didn't understand. We're going to look at something related to how markets move, because a lot of people misunderstand what it actually is that makes markets go higher and lower. We're going to then look at what charts are actually showing us. We're going to look at liquidity imbalances, exploration patterns, and we're going to wrap things up, and hopefully we'll have maybe a nice discussion at the end and answer some questions and go through a few examples. So if you have any questions during the presentation, write them down, and at the end you can chuck them in the chat, and then we can cover those, and I can try and answer them if I know the answer to them. All right, so what is liquidity? Well, liquidity is, I mean, if you look at the word liquid, you know, you have a bathtub. If you have a liquid bathtub, then you can have big waves in the bathtub. You know, when I used to bathe my boys in the tubs when they were quite small and there was a lot of water in the tub, I could take the tub and I could shift it back and forth on the floor in the bathroom, and the waves would go back and forth from side to side. And if there was a little bit in the bottom, I would do that and nothing would really happen. Then the waves would become quite erratic. And the same applies to markets. Okay, and so if you have, well, not directly, obviously, but if you have liquidity, what is it? It is the ability to buy or sell an asset without affecting the price. So if you have a very liquid market like the Euro USD, spot FX, or some index like the S&P 500. I mean, these are very, very liquid markets. What does that mean? Well, that means that there are lots and lots of people who are willing to buy and sell at pretty much any price at any time. So that's a very liquid market. That means that I can buy relatively big positions anytime without affecting the price of the asset.
So
you have another one.
Ask you shortly if you could change to presentation mode, the slideshow. Sure. Could you do that? Yeah.
Of course.
I think it's just Shift F5 or something. Oh. Yeah. You actually had it there, presentation.
Oh, did I?
Yeah, I think on the presentation. No, the presentation.
Where is it? Presentation. Oh, here. Sorry.
Yeah,
there it is. Yeah. Sorry. Okay.
Great.
Good.
Thanks.
Of course. Okay, so here we are. Then we have illiquid assets, and illiquid means that you don't have someone on the other side of your order all the time. So you don't have someone who's always willing to buy and sell, and these include small cap crypto projects. We have tons of these now. If you go to your wallet, your Atomic wallet, and you scroll and you sort after the 24-hour difference in price, and you look at the ones that have gone up like 14,000% today, and you think, oh my goodness. I mean, that is a very, very illiquid product, and the reason it's gone up 14,000% was because somebody bought a lot of it in a relatively short period of time. And by buying a lot of it, it maybe means that maybe they put in maybe $10,000 and that was enough to make the price of the asset go through the roof. Another example are collectible wines or watches. I have a friend who collects very rare Rolex watches, and he has this beautiful Rolex that is from, I think it's from the 70s, 60s or the 70s, and it's been in the sun, and the fact that it's been in the sun, it colored the glass and the gold a little bit, and that made the value go up. But I can't take that watch and I can't sell it immediately. I'll have to find someone who's willing, and then there's a big negotiation on the price and so on and so forth. And so this inability to liquidate an asset makes it illiquid because it's difficult to get rid of. Okay, so what makes markets move? I mean, most people think that buying and selling makes markets move. And while that is true, it's more willing buying and selling that moves the asset price more than actual buying and selling. Because if you look at a price chart, we just go to a price chart quickly, and you can see here, can you guys see this here, my platform, my terminal?
I can see it, so I think everyone else, yes, everyone can see it, yes.
Because if you look at this, I mean, price went down, it left this area of value. We had supply met demand at value, and price went. So there was an agreement to sell here. We know that this happened because price left. But this agreeing in selling the pound American dollar here was going on here, but you can't see it until it happens. And so you have to identify these patterns in order to understand where the market is going to go. And so learning to spot these patterns of willing buyers and sellers is very advantageous. And you do this by looking at specific patterns, which essentially are a visual representation of pending orders in a market. Okay, you can see if we look at this swing here, how price went up, it went down to one of these zones, and then it went back up again. The reason that price went down here and then went up here was because that the last time price was here, we managed to move very quickly. So this shows us that historically, this is an attractive area. If you look left, we have another zone here that's finished. So this was probably an area of supply that was tested several times. Price rallied up to it, we moved sideways, and then we left. So this is telling us that we have an interest to buy here. So this is a reference point for us in the future, because this is, again, potentially an attractive price to buy this asset here. Okay, let's go back to the slides. And so what is actually moving the markets is unfilled orders, and these unfilled orders are typically in the form of a pending, a limit, or a stop, and they're just orders that are located above or below price. And so the market will move up to attract sellers, and it'll move down to attract buyers. Okay, good. So let's move on to the next slide. So what is a price chart showing us? If you look at the price chart, this one here, I mean, when we look at this, we can only see what has already happened. And so a lot of people say that a price chart is a leading indicator. It's actually not. It's actually a lagging indicator because it's only showing us what has already happened. Okay, and so this makes it, you just have to be very careful making assumptions about it. Okay, and so what we need to do is we need to look for liquidity distribution patterns, and this goes back to a lot of my discussions with these engineers at some of these big banks that all of you guys will probably know, and they would talk about how orders would be put into the market in these little windows, these price windows, and they would have an order, for example, to buy, I don't know, let's say 1,000 lots of euro American dollar, and there wouldn't be one big order sitting there waiting to get filled. That 1,000 lot order would get sliced up into smaller orders of about maybe, let's say, 20, 40, 100, 50, 200 lots, because if they tried to fill the whole order at once, I mean, that would affect the price of the asset. And this is not very good, because if you do this, if you put a huge order in, then you're showing your hand and you're showing the market and other market participants that you're willing to buy or sell at this price point. But if you take the order and you slice it up into smaller, subtle orders, then you can put it into the order and then it can be filled gradually. And if we go back to the price chart, you can see, let's find a really nice example where we had, okay, let's just look at this one here where, let's say there was an intention to sell here. I mean, there's not a great deal of supply here. All we had here, we had a price went up, it came down, it respected this level here, like this for a while, okay? And then price revisited that area. So price poked up into the area, okay? And so what's essentially going on here is that the people who are involved in, or the people who are looking to buy and sell, they want to buy and sell at price points where they know the market is going to move. And so, but at the same time, they don't want to put the whole order in at the same time. And so they have a little order here, another one here, another one here, and so on and so forth. So they take, this is the window of opportunity. This is the highest acceptable price. This is the lowest acceptable price. And they put them in here and they slice them up. If some of you have seen some of my previous videos, I talk a lot about pancakes, not only because I like pancakes, but also because it's a perfect metaphor for looking at orders. I'm just going to remove this algo trader here because I don't need it, and I need my other functionality here. Just 1 second. Rectangles, enable, boom. Okay, I want it to manage my rectangles here. And so this price went up into the right to the edge of the box. This is like the minimal accepted price. Then it went down. The fact that it went down and it actually gapped down, as you can see here, tells us, okay, that's interesting. That means that there was a lot of interest to sell at that price point, but the order wasn't filled, okay? And so maybe the bank has to buy a little bit more to drive price higher to reach the other orders that are slightly bigger and fill those, because this is what is required to, I mean, you have to drive the price higher to fill sell limits. And a sell limit is essentially an order that's sitting in the market at a specific price point. Once price reaches that price point, well, then the order is filled, it's executed, and then you are taken into the trade. Okay, so price rallies higher. When this advertising goes on of these higher prices, you attract breakout traders, but you also attract the smart money. And the breakout traders are saying, wow, let's go long. So they start buying, which is a bad idea. They put their stops below these lows here. And this is beautiful because the smart money knows that there are stops here and there are going to be stops up here just above this high. And so they're driving price higher to fill the other pieces of their orders, knowing that once price starts to break down, liquidity in the form of stops from the retail side of the market will be flushed into the market, and it will be used to fill the remainder of their position. So they get in at a slightly worse price, maybe here, and just continuation pattern, which is essentially what a continuation pattern is. Okay. Yes, so we can see where buy and sell zones are located. We're going to get into this in great detail in a little while. And we're also, as we saw on the previous chart, we're focusing on historical value, because if you look at, this is a beautiful analogy, and that is actually what's going on in the crypto space. If you think of Bitcoin today, the price of Bitcoin today is about $60,000. And if you knew 5 years ago that Bitcoin would be at $60,000 today, would you buy it at the price that it was available for 5 years ago? Well, obviously, I think we all would. But if you didn't know, then you probably would think, wow, I don't know what the price of it 5 years ago, maybe $300 or something. You maybe think, wow, that's really expensive. You know, like $300 for one Bitcoin. Wow, that's crazy. And so you need these historical areas of value to remind you. Let me turn my telephone off. There we are. To remind you where we had historically attractive prices on both sides of the market, both to buy and to sell. Okay, and so we have to focus on these. And if we look at this price chart once again, and we had, hasn't updated here, but we had this was we had a lot of attractive prices. This was an attractive price to sell at. You can see price touched it and went down. This was an attractive price to buy at. Price came down and went up. This was an attractive price to buy at. Okay, so if this was an attractive price to buy at, if price goes lower than that, don't you think that this is an even more attractive price to buy at? And if this one is attractive, this one is even more attractive. This is like this is the $300 Bitcoin. This is the $10,000 Bitcoin, and this is like the more expensive Bitcoin. Okay, so there's less buying here, a little bit more here, a lot more here. Wow, we have Bitcoin that's so cheap. We have the pound American dollar. It's so cheap. It's on offer. Okay. And so essentially we're looking for discount and expensive prices, and you can do this by looking at a price chart. And again, we're going to get into this in greater detail in just a moment. Okay, so if we focus on this concept of market liquidity, okay, let's assume that this is the marketplace. This is this is a completely random example. It's not really what it looks like in real life. But if I'm sure many of the people in the room here, they trade crypto, so they're well acquainted with the order book, where you can see the amount of liquidity at these different price levels. So this is an example of that, just a very simple example, where you have, this is a spot price here. Okay, so this is the current price of the market. And this is spot price plus 1, spot price plus 2, plus 3, plus 4, plus 5, so on and so forth. Okay, so what we have here, let's say that we have a market order that comes into the marketplace, and they're looking to buy 50,000 units of this asset. Okay, what would move the market more, buying the asset or selling the asset? Okay, this is interesting because if you look here, we're at this price point here. Let's say this is 1, and if we want to buy 50,000 units of this asset, so let's start with the sell example, because this is where my slides are telling us. If we're selling and we sell at market, our order for 50,000 is absorbed into the available liquidity below the spot price, which is 200,000. So when this happens, if I want the price of this asset to go further down, even by 1 pip, then I'm going to have to sell an additional 150,000 to get price to move lower. Okay, and so my order doesn't do anything. But if I come in and I look to buy, in order to fill this 50,000 unit order, the first 10 is filled at spot plus 1, the second spot plus 2, plus 3, plus 4, plus 5. And so in order to get my order filled, I have to accept a worse price. As I start filling my order, I get a good price. I did good fill on the first portion. So the first, this is like the the big block of orders that I spoke about earlier. It's sliced up into small pieces. This is what's happening here, where this one moves the price higher, and it keeps going higher and higher and higher. Why? Because there's thin liquidity. There's no liquidity available above price, and so price has to chase liquidity, and it moves through the thin liquidity. Okay, and so this is why when you look at a price chart, you have to be able to identify the thin side and the thick side of the market. And if you can see this, then you're in the money. Okay, this is really important to train your eyes to see. And so if I buy, I change the price of the market. If I sell, nothing happens. And this is essentially what slippage is. You ever done that where you've bought an asset? Let's say you buy a currency pair or a stock or whatever. And if you're trading relatively big portions, or even if you're trading some small cap cryptos, your order going into the market affects the price. And that's not very nice, because each time you fill another unit of your order, you get a worse and worse fill, which is expensive. Okay. So the prices move due to an imbalance in supply and demand. And when there's more demand than there is supply, as we saw on the previous slide, when prices are going to go higher when you buy, and the opposite for supply. So if I come with a big sell order, then this sell order is going to consume the liquidity available on the sell side of the market. It's just going to eat through it. And these small pools of liquidity, these pockets of liquidity are necessary to fill my order, but I'm going to have to chase them and get an increasingly worse price, which I don't want. Okay, so if we look at this, here's another visual representation of that, where we have liquidity. This is the amount of liquidity available at these individual levels here, these price points. We have 113, spot 0. We have 10 pips higher, 20 pips higher. And here we have a below price. Okay, so this is the open of the period. Let's say that this is 1 hour of trading time. This is the open, and this is the close. So the hour opens. We have the bids and the offers. They're moving into the marketplace, and they're moving higher and lower, higher and lower. Okay, and so we start to move down, and we find some pending buys potentially, okay, in the form of, so we find liquidity in the form of a pending buy, and this causes price to go higher. And we find some pending sells. This drives price lower. And the pending sell is a little bit bigger than this one, so now we move through this to consume any liquidity, like liquidity available at this area, and we go lower. And we keep doing this, and we keep pushing, we keep exploring both sides of the market. And this is why you often see price patterns where you have like an expanding pennant, you know, where you have an expanding pennant where you have the thin side, which is where the pole would be attached to, and then you have the wide side to the outside. This is liquidity exploration, where price is trying to find those big bids or offers. Okay, so price is going wider and wider and wider. But notice here in this situation that we have the thick side of the market, which is below. We have the thin side of the market, which is above. And so when price moves lower, we feel those bigger orders, and there's still remaining pending orders in the form of limits at these price points that are holding price, they're supporting price, okay? And this causes price to wriggle higher, because price will move easier and with less resistance through thin liquidity than it will thick liquidity, for the reasons we discussed on the previous chart. Okay, so in this situation, this is going to be a bullish candle where we open here and we close here, and we maybe have some wicks to the upside and not a lot to the downside. So we're seeing that we can actually, we're able to support the price, and we have more willing buyers than sellers. Okay, so how do you identify these liquidity imbalances? I mean, you can do them in numerous ways. The ways that I've taught myself is using something called asset strength, and the primary focus of today's talk, and that is the buy and sell zone analysis. And you can do this using other stuff as well. A lot of people like to use moving averages, and if a moving average is sloping up, well then you know that you have the thin side of the market, which is to the upside, the thick side, which is below. People use oscillators, people use trend lines, people use many versions of secondary representations of price. But I find that if you look at a price chart, you're doing this in a way that is much more accurate, because you're looking at price instead of secondary representations of price. You're making decisions based on this. Okay. All right. So if we look at this is asset strength. This is just a piece of software that I wrote, inspired by my conversations with the economists. And here we can see 8 currencies. Okay, so here we have my mouse there. Here we have the Swiss franc, we have the euro, we have Japanese yen, we have the Kiwi dollar, we have British pound, the American dollar, the green one, we have the gold color, which is Australia, and we have this one here, the magenta, which is Canadian dollar. And they're color coded in a way that it makes them easy to remember. Switzerland is very green in spring, the beautiful tree, so I gave it a lime green color. We have the euro, you know, the colors from the flag. The purple is because a Japanese woman I knew in Bali, she used to often wear purple, a purple hat. And so she's got purple. And here we have the New Zealand, the Kiwi dollar here. And this represents soil. They have a lot of cows in New Zealand. And cows eat grass. Grass grows in soil. And here we have the British pound, which is red. You know, the poppy. Poppy Day, National Poppy Day in the UK, like a red poppy. We have gold in Australia, the greenback, and then the color that was left over was magenta, so Canada got that. But here you can see a really beautiful and very actionable development in the prices of these 8 currencies. I mean, when this hour opened, or this day, or whatever this period is, when it opened, I mean, you could see that we had currency strength divergence, and we had the Australian dollar, Swiss franc was moving lower. And I know this because we have the Swiss franc is getting stronger relative to the Australian dollar. And the key word is relative, okay? Because you have to, I mean, if you look at this one here where we have the euro and the Swiss franc, they're both moving higher. Well, then this pair is going to be moving sideways. It's not going to be doing anything. Even though it's going higher, the price of this currency pair is not moving higher, because the relative strength between these 2 currencies is the same. But when you see something like this, when you see like very clear asset strength divergence in the form of the Swiss franc or the euro crossed with the Australian dollar, well, then you know that there's going to be a very clear trend in place on a price chart. Okay, so if you look at this, I mean, why is this this currency pair moving higher? Well, if we look at the differences in the strength between these two currencies, you can see very clearly here we have a very strong euro and we have a weak British pound. Okay, so we have this pair which is crawling higher. Okay, so what is that telling us about liquidity? It's telling us that there's a lot more buying going on than selling. And for the sellers who are looking to sell, they're selling with less quantity, and so the buying, the bids are just eating up the bearish liquidity above the spot price. Okay, so this is just a very clear representation of that. And if we look at this one here, I mean, where's this one going? I mean, this could be the euro Swiss franc, because I mean the price now is the same as the price over here, and so price is just kind of it's oscillating around some kind of a mean where we have kind of channel, or we have a resistance here and we have support down here. And this is the case because we have the Australian dollar, American dollar fluctuations in price, which are very clear looking at this, as you can see if you compare the two, but they're not really doing anything. If we tried to get a trend line and put it on these lines as a best fit, I think it'd be safe to say that they're kind of headed in the same direction, which is slightly lower. Okay, and this is kind of slightly lower, how we're exploring new lows and the highs are going increasingly lower. This is a very good visual representation of that. Okay, what about this one? This is going lower as well, isn't it? And so again, I mean, the thin side of the market is where? Well, it's probably lower, and the thick side of the market is above the market. And you can see here, in this example, we have the trees in the Swiss Alps against the magenta Canadian dollar. We have a very strong Swiss franc relative, again, relative is a key word, to the Canadian dollar. If we look at that once more, you can see we have some really nice sell-offs here. You can just see this is where these two, the Canadian dollar diverged from the mean, sorry, the zero line pretty aggressively around just here. If you look at that, well, started to do it here and it played out shortly thereafter. Okay, so again, this is a good example because when you're looking at this, you're seeing the developments in the strengths of these assets slightly before it is shown in price, which is interesting because it enables you to act before price has actually reflected what's actually going on with the underlying data. Okay, so now let's look at some buy and sell zones, which is the second one. If we go back up here, we have asset strength and we have the buy and the sell zone analysis. So we'll go back to that bit, and then we'll talk about this now. Okay, and so what we're doing here for buy and sell zone analysis, we're looking for attractive prices. And how do you find attractive prices? Well, you have to look for price points in the market where price historically retreated from. Okay, so turning points in the market. If we look at this is a really good example. Okay, where we had look at this one here. We had this one here and price left. Then we had this one here. Price went up to this level and it left. And it came up again and it left. Okay, so what's happening here? Well, this means that we are up here. We have, let me see if I can do some drawing here. I won't bother, I'll just use my charts here. So just here we have a pancake, we have a plate of pancakes, okay? And on that plate of pancakes, we have pancakes. And each pancake represents one pool of liquidity, okay? So this is a pending sell limit, okay? So price pokes up into the area. Let me zoom in a little so it's clearer. The price pokes up into the area. Where are we? Because it pokes up into the area. Sorry, it's disappeared. Let me go like that. And these are data. Because the price came up into the area and then it left. Okay, when that happens, we have a sell zone. And we know this is a sell zone because we can see the price turned away from it. So this was an attractive price, shorter term, to sell the British pound and buy American dollars. So this becomes a reference point to us in the future. We have another one. There are a lot of areas on the chart, but so try not to focus too much on those. But know that this was an attractive price because we had the pattern, we had liquidity distribution, boom. Okay, so we had maybe sideways price movement, then we had currency or asset strength divergence, price left. Price came back to it, it went to the first pancake, took it. So it filled the first order. And if we go back to the slides here, okay, so price goes up to it, just here, then it turns around, okay? And it goes a little bit deeper to find the next one, and it turns around. So we go back here, it goes up, and it turns around. There's a little test here, and it goes a little bit deeper, it turns around. And it goes a little bit deeper, and this is where we found that big pending limit, maybe up here of 100, let's say 100,000 units of whatever this asset is. And this was enough to consume shorter term liquidity below price to drive it lower to the opposite side of the market. And it did, it went down here, it left here, we filled the market, it became an imbalance in supply and demand, and price came down. And it started to revisit these historical buy zones. And here we have a buy zone right here, we have another one here, and we have another one here. Price went below the first one and went deep into the second one. And this is where it retraced from, and it left, and it visited again, it revisited this one, okay? And that was enough, but not quite enough. Why? Because we formed an area of supply here, and we created a sell zone. So price poked into this one here. We had new willing sellers in the market. Price came up, and then we left. And what did that do? That actually consumed this area of demand. And we know this is an area of demand because we have a buy zone here. And the buy zone is telling us that at this price point, this asset is attractive shorter term. Why? Because last time price was here, it left, okay? It came down, it went up, but there's more selling here than buying. Price went down, we poked through this, we almost came back down to this area here. We tested the beginning of these buy zones here, then we came up, we moved into this area of supply. First time we poked in, we left. Okay, going back to the slide, this is the same thing happening over and over again. We go up, okay, no reaction, a little bit bigger, a bigger reaction, but not enough. Now we have, and this is like market manipulation, not market manipulation, liquidity exploration, sorry, where price moves through all of these historical levels and it finds what I refer to as like a parent area of supply or demand, okay? And the parent supply or demand is an area that was established independent of the existence of any other area of supply or demand, okay? And this actually is a child. The parent is here. And you know this is a parent because this was established, price tested it, we have sell zones, we tested the child here. I hope this is clear. If not, Christian, if you see in the comments if someone says, whoa, I don't understand what he's talking about, let me know and I can slow this down because it's a little bit of a mouthful initially. Okay, so we have this one and then price left. When it left, we're seeing that there's an imbalance in supply and demand, okay? Price revisits the edge of that area into the parent. That right there, when that happens, we have a sell zone right there, okay? Which tells us high probability trade for the future. But the child, there's enough selling at this child area of supply that this caps price for the time being. We first visit the child, so we have a sell zone here for this child, goes a little bit deeper the first time, a little bit deeper the next time, and then we form a new child, which caps price. And this new child caps price, and then price starts to move away. Then we move through all of these areas of well, this is of child demand below price, and then it moves away. Okay, and so looking at a price chart, and you can have a really quick glance at a price chart, and you can make assumptions about what it's doing, or you can really put your X-ray vision on, and you can study exactly what is going on, and you can ask really intelligent questions, and that is, where is an attractive price on this chart? And if you look here, if I zoom out even more, okay, price came all the way down here. Price was here, it went all the way up here, it came all the way down here, and then it went all the way back up here. what does that tell us about this price around the lows of this area here? That tells us that there's an interest to buy at this area. And you can see if we go here, you can also see that what's this? This is a buy zone. So here we have demand. Here we have, excuse me, we have the buy zone. We know this is a buy zone because why? Because price left and we came back and then we left. Okay, so this is a flashing arrow pointing at a price window saying this would be a really nice place to begin to buy pounds with American dollars. Okay, price comes to it a few times, then it leaves. We try to come, we suffice with the child, and then we leave. We're overwhelmed with the selling up here. We come back down, we poke back into this area of demand. Okay, we form another buy zone here and another buy zone, and then we start to consume the supply above price. Price tests it once, twice, it rallies, we accumulate right on the area, then it pops up. What's that telling us? So that tells us at precisely this price point, there was a lot of buying. And we know there was a lot of buying because we were able to consume all the liquidity available at this complex supply just here where price rallied. We accumulated what positions to move price really far north into this bigger area of supply here. Okay, so this is a key point for the future. Price goes up, it comes back down, it tests it, and then it moves up, okay? Then it comes back down, and then it starts to move up. And now notice that this area of demand has been removed by what? Where's the box? The box is above. The box is above. And this is the origin of the move that moved through this demand that was tested. And so this is where you trade. Price came to that box almost, so the buy zone was established, and you think, nice, we have a buy zone. So then you take let me remove this. So now we have our sell zone, which is right here. Then you sit on your hands and you wait. So I know I'm going to sell at a price no cheaper than the high of this pullback into this area of supply. Okay, and if I remove, is this a box here? Yeah. Come on, bugger off. Okay, so price went up and it turned around, and it went up, it tried, it failed, but now we poked up. Look at that wick, and it stopped. What did price do? It couldn't stop here because that pancake was gone. That little poke, that order, that sell limit had been filled, so it's not there anymore. So if it wants to find more sellers, it's going to have to advertise higher prices. Okay, so price went higher, and this is where we found it. Look, price went up there and all the way up here, and then it went down there. And that was that's 85 pips from that move. That's a pretty big move. Okay, and then it kind of stabilized, and now it's figuring out what it wants to do. Now it's out of session, so it's not really doing much. Okay, and so I hope you can see that it really isn't rocket science. It's just a matter of focusing on the detail of a chart. When I used to work with computer security, I worked in the computer virus industry for about 3 years, and we used to analyze computer viruses for banks. And the guy who I used to do a lot of these projects with, he used to say to me, Sarid, the key, he'd say, God is in the detail. He's like, God is in the detail. And I was like, that's so true. And all of the, and we had if we had a bank would send a piece of malware to us and say, this malware is stealing money from our bank. Please figure out how it's working and how we can fix it. We'd analyze it. And the more you paid attention to the detail of what was actually going on in the assembly code of the virus, the quicker you could solve like Golden, it was like divine goal, it's like this really weird mystical thing, and I didn't get it. But the more you paid attention to the detail, the more clarity, the quicker clarity came. Okay, and this is the exact same thing. God is in the detail. Okay, so you really have to focus on this. You can see the price went up, then it went down. This is telling you, this is the chart speaking to us. Okay. All right. Okay, bang, good. Okay, let's go to the next slide. We've already been through these, so we'll go on. Okay. Okay, so now we have, and I kind of went off on a tangent there, a bit in detail. I hope that was okay. I find it fascinating. I could do this stuff all day long. But we look for attractive high and low prices, which we really touched upon, I think, in the previous stint there. So then you have some questions that you can ask, and I talked about asking intelligent questions. And you can ask, like, what did price return to before they turned? Okay, and this is again something we talked upon here, where I mean, price left, we went up, we pulled back the slingshot. I will talk about slingshots, where essentially we have established a buy zone. This is the buy zone here. This is where we reference to buy in the future. Price went a little bit deeper and then we left. Okay. I mean, we can also ask questions like, how long did price stay at the attractive price? And you can use this actually in real life. Okay, iPhones. I don't know what an iPhone costs. I have Android, but a telephone, a nice, shiny, brand new telephone. I know an iPhone doesn't cost 400 krona. But if I had a little booth on the side of Västerborg in like Copenhagen, and I said, get your brand new iPhone, what are they on, 12, 13, 14, X whatever, 400 krona. I mean, I would, I think I'd probably lose a teeth. That's how quickly these telephones would be sold. Okay, and so how long did the supply that it was available of my telephones last? How long did I have that supply? I had it for like maybe a few minutes before it was all gone. The same thing applies to trading. How long did price stay at the attractive area? So if we go back to here and look at this, this is a really good example where, I mean, price rallied, we moved sideways for one period. This is 1 hour. And this is important because from here, price consumed everything over here to the left. How long did price hang out at this price point? How long? 1 hour. That's not a lot of time. How long was price up here? Many hours. Let's have a look. Price was there for 16, 17 hours. Okay, that means that price is going to move through this easier than it's going to move through this. Price left so quickly that if price ever comes back down here again, people are going to be super keen on buying whatever it is I or the market has for sale at that price point. When price sits around in an area like this for such a long period of time, I mean, that's not an attractive price. You want to look higher, okay? And so looking beyond these and at areas like this is also a really good way to train yourself in identifying these really attractive prices. And if you look at this one here, we formed this area of supply, price left, we moved sideways, we were there for 1, 2, 3, 4. I have a rule that it cannot be for more than 5 periods. So I have 1, 2, 3, I have 4 white candles. That's good, and that's a really good, that's a nice one. And the fact that we have wicks above tells me that I want to go down to a smaller time frame and analyze the price action, because what I'm seeing here is actually, this is kind of a macro area of supply where this is a slingshot. So this is the beginning of the sell zone. So I wouldn't want to sell here. I'd want to sell from the highs and above, just like this one. I want to sell from the lows and below. This is the same thing here. So this is an attractive price. Why? Price left in a hurry and it didn't hang out for an extended period of time. All right, and how did it leave? Did it leave quickly? Yes, it left very quickly. Price really, really went, and it went far. So we want to see price be in the area, a price point for a limited period of time. We want it to go far, and we want it to get there quickly. Okay, so price left here, and it went all the way down here in 1, 2, 3, 4, in 5 hours. That's not a lot of time. And in that 5 hours, we actually managed to remove this strong area of demand, okay, which was tested once, and now it's gone. Okay, and this is essentially what I refer to as liquidity exploration, where you have, essentially you have the price of an asset. So you have kind of the market, people who are just like doing business, buying and selling, whatever it is that's for sale. And this buying and selling causes the market to go up and down. But the really big buying and selling occurs at strategic places in the market where you have a clear imbalance in supply and demand at areas of value. Okay, and so what we're looking for the edges of buy and sell zones. And the edge of a buy or a sell zone is what we've touched upon already, where we have an area of demand, price leaves, we have the slingshot pull back. I always refer to these as a slingshot, okay, because it is kind of that, how like price leaves, you pull the slingshot back, and it snaps up here. I mean, that's a beautiful release. We have a lot of wicks. This is a wick is an arrow. It's pointing okay? It's pointing not here, it's pointing below. Okay, this wick is not pointing here, it's pointing here. So that means sell above, sell below. Sell above, sell above. Price went up, it turned around. Okay, so wicks are arrows. And if you view them as arrows, then it slightly changes the way you view these candlestick patterns. Okay. Yeah, price moves quickly when there is an imbalance, a big imbalance, as we've seen. Big orders need much liquidity. And this is interesting, actually. Let's see if we can find another chart. Okay, let's have a look at, I just want to find like a really clear example of what's going on. Okay, so let's have a look at this here. This is not a perfect example, but it'll do. Let's go back here. Okay, so what we have here is price came down. We formed this area of supply, price left, it went up, it came down, and then it came up again. This, I think most of the people in the room, or some of the people in the room, are going to be aware of the concept of divergence. It's often referred to as MACD divergence, where you essentially, let's go on the smaller time frames, I'll find an example very quickly, where we have, okay, let me find something else to look at. Let's look at the euro American dollar. Okay, where we have, for example, an area, this looks like it could be divergence here. Let's wait for the oscillator. This could be my MACD, but it's not, it's something else. But yes, this is beautiful. Where we have price going lower, we have the strength between these two currencies is doing something very different. It's going higher. So when this is happening, I mean, this is liquidity exploration. So what we're doing is we're advertising, we're doing a couple of things. What we're doing, number one, is we're trying to onboard sellers, because if you have a big order to fill, you need liquidity to fill that order. And if there is not sufficient liquidity in the market to fill the order, you have to find it. And where is that liquidity? Well, it's going to be in the hands of other people in the form of stops or pending orders. So if those are stop orders or pending orders, you want to fill those orders, because once they're in the market, they are financially obliged either to hit their target or to hit their stop. Okay, but I can't get my hands on that liquidity if it's still in their hands. But what I can do is I can shake people out of the position. So if I'm a big bank and I want to, I mean, this is a better idea. This is a better example here, where we have price moving higher like this, and we have the lows over here moving down like so. Okay, where we have price going higher. So people thinking, the consensus is, if you're only looking at the price chart, the price is moving higher. So we have maybe some people who are less experienced and a little bit anxious, and maybe some people who are looking for a bit of excitement. So they're not happy unless they have a position, so they can see the P&L going up and down. Ooh, it's exciting. It's almost like going to Thule. Okay, so price is going higher, and the smart money knows this, so they chase the price higher. Okay, and when this happens, you have breakout traders, and breakout traders say, price is going higher, we broke out, we're buying, so they jump on. So they buy. Okay, so they buy maybe here, and their stops, they're down here. Okay, so what they do is the smart money, they race price higher, and now they know that there are stops down here, and now the liquidity in the market is in the marketplace, but it's still in the hands of the other people. So they need to hit those stops to release it into the market. Okay, so this happens when this happens. So the bank or the big speculant will race price higher, okay, to attract buyers, knowing that they'll put their stops here. When they do that, then they start to unload the first portion of their position, which will drive price lower. When this happens, we empty all of these stops into the market, and it's used to fill the order. And then when this happens, the retail guy's like, oh man, I just got stopped out. Oh, now it's going down. Now I'm going to sell. And so they start selling. They sell here, but now it goes up. Okay, and this is just the smart money shaking the smaller guys out of their positions, not because they're mean or they want to do that, but they're just doing their business. They need to fill these orders. That's what they're doing, and they're looking for liquidity. So this is why I refer to it as, you can call it liquidity exploration, or stop hunts, it's also referred to as. But this constant moving up and down, this is essentially what's going on. And when you see this, where you have a divergence going on, this is essentially what's happening, where you have prices running higher when you have an oscillator or a currency strength indicator or whatever else is doing something different. This is essentially what's going on. But I mean, it's very important that it's happening at very specific areas. If it's happening randomly in a move, it doesn't necessarily mean that we have liquidity exploration. It can just be that price is doing what it's doing. Okay, so this is an example of liquidity exploration. Yeah, and so the banks here, I mean, they need to fill their orders by finding liquidity, and these are going to be found in the form of pending orders in the market, as we discussed just a second ago. All right, so final words. Yeah, I mean, I like this one here. I mean, my wife, she writes books about design and sustainability, and I remember she used to talk about KISS, which stands for Keep It Simple, Stupid. And if you're doing something and it seems like rocket science, especially trading, then you're doing it wrong, because trading is the furthest thing from rocket science, unless you're doing some crazy algo trading thing. But I mean, essentially, you want to buy when price is low and you want to sell when price is high. That's it. That's all you want to do. And you just want to time your entry so that you're getting it at a decent price. And if you're also then, I mean, considering who is on the other side of your trade, and you can do this by looking at a chart. Okay, I mean, if price is racing here and I'm looking to sell, I have a conviction to sell because over here to the left there's an area of supply. I mean, who's buying here? Is it Nordea? Is it Danske Bank? Is it Credit Suisse? No, man, it is absolutely not them. This is the small retail space that's buying here because they're breaking out, because of there's an area of resistance, an area of supply that's been removed, and this is a bad idea. So before you get into a trade, ask yourself the question, who would I be buying from or selling to? And if you ask this question, it forces you to stop even for a moment and consider this question. And this will put you in a better headspace to make further decisions. And again, here I say trading isn't rocket science. It really isn't. And if it feels like it is, then you're probably overcomplicating it by using way too many indicators, technical indicators. They can be useful, but they can also remove your attention from what is actually important, and that is price. I mean, this is important. These are less important. They do tell you things, but you can already see these. I didn't know, sorry, I mean, before this indicator loaded, I knew that it was going to look like this. Okay, and this is because, I mean, you're looking at this, how we have a test, price comes up, we test, we come back down, so we've established the buy zone, we're doing divergence into a buy zone. I mean, there's a very high likelihood the price is going to go up from here for the reasons we discussed previously in the presentation. Okay, so keep it simple, and I won't call anyone stupid. Okay, cool. Well, I'm gonna maybe open it up. I kind of rambled on there for a while, but I thought maybe Christian, if people have some questions, and we can touch on those and maybe cover some stuff. I hope it was clear. I really tried to explain things in great detail to help drive some of these points home. It's a very, very fascinating topic.
I think it was clear, but I have seen a lot of your videos, so I would like, of course, to ask the audience if there's anything that you were unclear about. I would say that there are a lot of questions about the time frame, so maybe you could go a little bit into that. So for instance, Jørgen is asking if it matters which time frame you use using the supply and demand indicator.
Sure, this is a really good question. Was it Jørgen?
Yeah, Jørgen. Yeah.
Yeah, Jørgen, godt spørgsmål, and it's a really good question, and I can tell you that I mean the supply and demand software is the one that draws these rectangles, but I have a utility that I created about the same time as I created the supply and demand software that was actually, it was like a trading robot, and I didn't use it to trade. I used it on the back tester and in forward testing to help me identify the most beneficial default parameters for the software. And the software, rather the data, has showed me that the half an hour chart and up are the better. The 4 hour is a really good one. The daily is a really good one. But when you go below that and you go to the 5 minute and the 1 minute chart, it's really difficult. It's really difficult to see what the major flows are doing. And you need to understand this in order to make, excuse me, got the hiccups, to make better trading decisions. And on the 1 minute, there's a lot of noise. If we just click onto the 1 minute, we're out of session now. But if we look at this, it's, yeah, okay, now we're out of session. So it's difficult to say, but if we go back a little while, you have these like, whoa, it's like, it's an emotional roller coaster. When you take the helicopter view, you go slightly higher, just slows things down a little bit. You get these like really erratic, like oscillator results as well, and it can get quite difficult. So I would recommend from the half an hour and up, you can use it, but it'll work on anything, really. It works well on anything. Here we had this one here, price came down, it sat on it, went through it, went down to this one, but it's going to work less good on the smaller time frames. But it'll still work, but it'll require a lot more of an aggressive trade management approach from your side. Okay, I hope that
questions. Yes, I think that was clear, but we also have several questions about what you talked about with the child and parent. I think it's something that was unclear for several people. We have more questions about that.
That's a really good question. It's a very important question as well. So I'll spend a second touching on that. Okay, so essentially, the only reason I call it a parent and a child is to underline the fact that there is a relationship between one area of supply or demand and another. Okay, and so if you have an area of supply or demand, and if we have an area that is created, okay, this is a good example right here, where we have this one here, this is an area of supply. This is a parent supply, and this is a parent supply because it was created independent on any other area of supply. Okay, so price formed this pattern right here in the middle of nowhere, right here. This is another parent, this is a parent, this is a parent. This one here, this is a child, and this is a child because this is not supply, this is a reaction to supply. This is the supply, this is a reaction to it, but the software is going to show it to you anyway. It's going to say, yeah, here we have a level of supply, and we did have one, and it worked out beautifully, but it doesn't change the fact that it was a child. And so as with like human beings, you can get a good story from the kid, but if you want the truth, you go to mom or dad and you can, okay, mom or dad, what really happened? And you'll get maybe a clearer perspective on the truth. And it's the same kind of thing here. And if you want truth, you go to the parent supply or demand. If you want maybe slightly higher risk interaction with the market, then you can trade child supply and demand. I used to say trade children, but I changed that because it's not a very popular thing to say. All right.
Okay, Tom is asking about what is your win rate, and that's actually something that we talked about today. Sorry, I remember.
Yeah, it depends. We have several hundred people using the software, and the results vary tremendously. And it is the people who come to it with clear expectations, rather realistic expectations, and gravitate to the higher time frames seem to do a lot better than those who come and are looking for quick returns. I think the crypto space has completely destroyed our what realistic expectations should be. Okay, and so it's quite difficult. But we had today, I was trying to find an email from a guy who uses a piece of software that we have, and he was saying on the 4 hour chart, the half an hour and the 4 hour chart were his preferred time frames, and he had a hit rate of, I think the worst hit rate was 69%, and it went up to I think 83 or 84%, something like that. But this brings me to my next comment, and Christian, you'll remember this very well. Do you remember like a few years ago, there was a gentleman, Klaus Munk, something, a chap from Singapore or
Yes.
Skanderborg?
Yeah.
Yeah. He was a remarkable individual because he was one of those people who came to it with a really clear mindset. He had realistic expectations, and he did what he saw he had to do, even in the face of 3 losers or 5 losers before. And this guy, applying the stuff that we talked about today, he had a win rate of less than 30%, but he was extremely profitable. And this goes back to the whole concept of risk reward, where you have trades that, they get filled, and if you're fearful and you take the trade off, let's say you took this trade off when it got to here, or you took this trade off when it got to here, price came down the first time and it went up, and you said, oh, it's coming down, oh no, oh, I'm a little bit nervous. You start to get nauseous, and then you maybe close it off here. But this guy, he had like easy mail, and he could just sit on his hand, and he would just let the process work its way out, and he would leave it, and he was having 1 to 5, 1 to 13 risk reward, and this is a game changer. And so win rates are not as important as metrics such as average win to average loss.
Yeah, that's a very good point. And for those that have been following Daytrader.dk for many years, they will actually remember that Klaus was the winner of the competition, the trading experiment that we held. I think it's several years ago. So he's the guy. Several people have asked about how is the asset strength calculated. Is there something that you can say something a little bit more about?
Yeah, sure. Asset strength is it's calculated where for a currency pair like let's say this one here, the British pound, American dollar, what I'm doing is I am looking for all British pound crosses. So here we have the pound American dollar, the pound yen, Aussie CAD, Kiwi, and all of the other ones. And I'm calculating an index for the pound, and I'm doing the same for the American dollar. Then I'm subtracting one from the other, which is giving me a histogram. And then the histogram is the data that I feed into a very simple quantitative model. And then I calculate what's known as like a mathematical variant. The Scandinavians are very well educated, so they'll know exactly what that is, or many of them will. And it's essentially, it's a way to find, if you have a bunch of people with a bunch of numbers and everyone has to guess between a number of, let's say, 1 and 100, and let's say most of people's answers cluster around, let's say, 50 plus or minus 20, but there are some people who choose 100 and there are others who choose 0. This 0 and this 100, it's going to change the average without actually representing the average, if you know what I mean. And so using like the quantitative model that I've created, which is actually pretty simple, it's just nothing fancy at all, it enables me to calculate like an extreme high reading for an asset, rather extreme high price or an extreme low price. And so when price pokes into that, like you see how price went up here and went all the way up here, when it started to turn negative, it was saying you need to sell, and it started to go down. And down here, oh, we went negative, and so it's time to buy. And when this happens at this, then we have a confluence between buy and sell zones, and we have this. But it's essentially based on currency strength and like a pretty simple quantitative model.
Okay, and then I have at least 3 questions about if this can be used for anything else than forex or currencies, and I know we've talked about that too. So can you tell us a little bit about that?
Yeah, sure. It can be used for anything that your broker has access to. If I just go here and say show all, I'm going to get futures contracts. You can put it on cotton. Let's have a look. We put cotton on there. Just have to let it run. Just has to do some crunching, and then all of a sudden it'll start dancing, and then it'll start to analyze. Right now it's analyzing the data, and then it starts to spit out these areas. Yeah, so it can be used on anything, anything at all. Commodities, crypto. anything, whatever your broker has a price feed for, it can be used on. I've used
Okay,
it.
and people are especially interested in stocks. I think
Yeah.
several people asked about that.
Sure. I mean, my broker doesn't have any stocks, do they? No, but there are loads that do. I know markets.com has they offer stock feeds in their MT4 terminal, so you can use it there.
Yeah. Okay. So some people are asking about the white candles in your chart. Can you say some more about that?
Yeah, sure. So the white candles, they are, I mean, what they're doing is they're looking inside the candle, and they're looking for very specific behavior. So they're going to smaller time frames, and they're looking for a specific kind of price behavior inside that candle. And if it sees it, then it paints it as white. And the result of the analysis is essentially telling the user that we have a momentary pause in price, and this momentary pause resembles accumulation or distribution. And so you'll often notice that, I mean, we had a lot of white candles here, so price will often go up to it and turn around. And so when we had some more white ones here, price went up to it more or less and then turned around. We have some more down here, price came down to it more or less and then turned around. So it's essentially telling us where we have liquidity moving from one side of the market to the other, from the sell side to the buy side, or from the buy side to the sell side.
Okay, and then we have several people asking about the indicators. And first of all, there is a trial version of the supply and demand indicator as a part of this program. And if for some reason you haven't got it, you can go to Daytrader.dk to get this trial version. But also several people are asking about the asset strength indicator, or histogram, I think. And they're asking how can they get it, and like now most people got the trial version, but how can they get the full package?
Yeah, I mean, all members of Pipnotic, they have access to everything. So the asset strength and the supply and demand software. But if you just want to try, you can go here. You go to pipnotic.com. You go here. You go here to the dashboard. On the dashboard, there's the asset strength. And here on the asset strength, I have a video that tells you how to use the asset strength data, and then you can go down here and you can view here. And here you can see a ton of stuff. We have 80 symbols, and I mean, here we can see that we have the pound Australian dollar is ripe for buying on the 15-minute chart, and the pound CAD on the 30-minute and the 15-minute chart. So you can go here, and then here you can look at it and use it. And but it's not going to be as kind of useful as we have here, where you can actually see like the developments over time.
Okay, and I think we're going to take the last questions now. There are so many, it's a little bit difficult for me to track if I got everything. But
Sure.
some people are asking about how you set the take profit.
Really good questions again. Okay, so trades, when you see a zone like this, for example, this one here, this would have been traded typically where you would find the area, the box. So you have the bottom end of the box here. So I would typically look for the sell zone, which would be the high of this candle. And I would normally, if it's really close to the area of supply like this one, then I would just put my entry here at the edge of the zone. Then the stop would go, I'd make it 2 times the size of the area. And the target would be at the opposite opposing side of the market, which for this one would be down here, because this is right here. This is a buy zone, so this is going to be a price sensitive area. So I'd expect price to go back down to roughly this area here. So the edge of the box that's closest to price is the entry. The edge of the box is furthest away from price. That would be where the stop placement would be. and the target would be at an opposing area, an opposing biocell zone.
Okay, I think I think we have to try to round it up now. I think we actually only set off around 1 hour for this, but
Wow, okay,
it
sorry
was
about
so interesting and so many questions that I think we could continue. But luckily we have 2 more webinars with you, Sarit, and
Yes,
I think
look forward to
maybe
it.
if you could say a few words about the next webinar, because I think we were talking about cell and buy zones, but maybe you could say, do you have any plans? Could you elaborate a bit on that?
Yeah, we're gonna take a deeper dive, I think, into buy and sell zones, because this was pretty much about liquidity distribution and how to see it on a price chart, and so there's a bit of overlap between this webinar and the next one, but the next one we're going to do many more examples on all sorts of different assets. We're going to combine. We're not going to use so much asset strength, because I'd really like to focus on this, because this is I mean, understanding buy and sell zones is as close to the holy grail I think that you can get, and so I really want to spend much more time discussing this via different examples, and maybe throw in a little bit of theory to help everyone kind of understand exactly what it's all about.
Okay, Sarit, that was a great presentation, I think, and I think the number of questions shows that the people had a lot of interest in this, and also we had very few people dropping off, so that's usually a very good
Excellent.
sign for people
Beautiful.
being interested in this. So I hope everyone will be back for the next webinar. If there's anything you thought was unclear, or anything you would like us to discuss in the next webinar, you're welcome to write to us at support@Daytrader.dk. And I see that several people are writing that it was a very good presentation and very interesting. And for those of you that haven't gotten this trial version of the indicator, go to Daytrader.dk or the Swedish or Norwegian side if you are Swedish or Norwegian, and get started on the program, and then we'll get back to the next webinars. And I think the next webinar is at Wednesday next week. So I'll be looking very much forward to that. Thank you a lot, Sarit, for
Hey,
being with us
thanks.
tonight.